Nilesh, there was one question. This question is related to index funds versus actively managed funds. So, what kind of allocation people can give for both, and which one is better?
So, one, I'm an active fund manager which also provides index funds. But again, social media, there's so much of noise as if active fund managers have underperformed index and one should move from active funds. Now, Ramlingam, if you actually see, index funds are underperforming index. Median of index funds linked to Nifty have underperformed Nifty by a percentage point, and so did Sensex. Now, why are index funds itself underperforming index? Well, there are multiple reasons. One, till a month back, when you give 2 lakh rupee application, we were allotting same day NAV. But money used to come many a times much later. Second, in any fund when there is churn, you are getting money, you buy, there is a transaction cost. You are facing redemptions, you sell, there is transaction cost. That churn invariably creates underperformance because there is additional transaction cost. Third, in index, a stock is included or excluded at closing price. But it doesn't happen in real life. If tomorrow Vedanta is getting delisted, yes, it will happen at one price. It can go out of index and fund at the same price. But if Tata Power got out of Nifty, then you can't sell it in one day. You have to sell it over a period of time. But index assumes it's gone in one day. So there are challenges of managing active funds, and which is where you need to appreciate active funds performance vis-a-vis those constraints. If constraints like giving NAV for 2 lakh rupee investments, if there is more churn, there is underperformance, and index getting included or excluded at closing prices, these are pushing index fund to underperform index. On active funds, there are even more constraints. I can't invest beyond 10% in a stock, but in Nifty, Reliance is at 15%. Now, these are the challenges which impact fund managers' performance. And despite those challenges, we have delivered alpha across many of our funds. Earlier, we used to give alpha consistently over 1 year, 3 year, 5 year, 7 year, 10 year period. Now, there are occasional periods where we haven't delivered alpha for the reasons which I mentioned. But if you look at a cycle, we will be able to generate alpha. So if you are in good quality, actively managed funds, I think you can remain invested. The important thing is to look at portfolio and then take a call rather than whether this is active fund or passive fund. It's the portfolio which delivers return to you. So if you think index portfolio is better than active fund, invest there. If you believe active fund portfolio is better than index fund, invest there.